On January 22nd, 2025, I took a short position in Tesla via long-term puts on the stock. And on April 7th, last week, I closed out that position for a 260% gain. Today, I want to go through exactly what I was thinking when I started that position, why I closed it out last week, and how I generated asymmetric returns from shorting a stock. Asymmetric investing is normally all about buying stocks where you know that the only amount that you can lose is the amount that you put into it, but the upside potential from a stock is theoretically infinite. And those are the kind of advantages that I'm normally leaning into on asymmetric investing. But this was a special situation, and that is what I called it when I started it. There was specific exposure that I was looking for. There were reasons that I wanted to short Tesla specifically, and it worked out extremely well. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you want notifications of all of my trades, like this position that I put on with Tesla, sign up for Asymmetric Investing, my newsletter. There's a link on the screen and a link in the show notes. I've got a market beating portfolio where I tell investors exactly what I'm going to buy every single month before I actually make those transactions. And then we track them. I do deep dives on every single stock that I own, and there's full transparency into that portfolio. So if you'd like more from me, that's a great place to start. And this video is sponsored by a tool that I use constantly in my research, that is FinChat. If you go to finchat.io/ASYM, you can get 2 weeks of FinChat Pro for free. I'm going to be using some of those tools here on this video, but this is where I get all of the phenomenal charts that I use, whether you're looking at income statements, balance sheets, cash flows. But the great differentiator for them is their KPIs. They have key performance indicators for thousands of companies. So if you're looking at a stock like Tesla and you want to know what were their deliveries for each quarter, you can pull that up extremely easily. How much revenue did they make per vehicle? What was their margin per vehicle? All of this information is very easy to pull out. And on top of that data, you have all of their earnings transcripts and the audio, investor relations sites, buys, transactions from insiders. Everything that you need to know is all in one place on FinChat. That's why I use it constantly. This is a tool that I pay for myself, so I'm putting my money where my mouth is. Like I said, if you go to finchat.io/ASYM, you'll get 2 weeks for free. If you like what you see there, you get 15% off through that link. Let's go through Tesla, and I'm going to actually walk through the logic that I published on January 22nd. Like I said, this is what I sent out to Asymmetric Investing subscriber. And keep in mind, on January 22nd, Tesla stock was trading for $415.11 per share. There was a ton of hype in the market at that point. The inauguration had just happened. The market was on an absolute tear between the election and inauguration. And there was a lot of thoughts that everything was going to be great about business. That has clearly not been the case over the past few months. But we didn't know that in January. In January, there was a lot of optimism. And I really wanted to use that as an opportunity to sort of hedge the portfolio. And this is what Musk said himself: the most entertaining outcome is the most likely. So the exposure that I was looking for from this position, I wanted to have some upside if some of the overvalued stocks in the portfolio, and plenty of the stocks that I own in the asymmetric portfolio, were extremely highly valued at this point. A lot of them have come back down. In some cases, they've fallen 50% or more. But I don't necessarily want to sell those stocks because I don't want to try to time the market. I just want to buy and hold because my thesis is that these companies are going to be much, much more valuable 5, 10, 15 years from now. I'm not trying to day trade the stocks that I do own, but I am interested in looking for a hedge if we have a very highly valued market and there's potential downside for that stock. So that was one of the things that I was looking for. If the economy turns south, now I'm going to talk about the position that I took, the options position, but this was a 2-year options position. So I had the opportunity to take some upside if there was some sort of unknown things with the economy. China, I put here, China invaded Taiwan. There's a commercial credit crisis, or any other unknowns or known unknowns that could potentially take the economy down. The third thing I said is upside from policy changes. You can note here that I even pointed out tariffs or reduced renewable energy subsidies. Now, we have not seen changes to the renewable energy subsidies, but tariffs have obviously been something the market has been very focused on just over the past couple of weeks. But again, in January, we didn't know exactly what that was going to look like. So the general reason for putting on a position like this was as a hedge from some of the overvalued positions, maybe in the portfolio or the market overall being overvalued. Now, the position that I bought was an options position, and these options were options to sell the stock. They are puts, and they expired on January 15th, 2027. I had 722 days for this position to work out. Now, I bought very, very out of the money options because this was only a trade that I put $500 into. So these were $5, and then you have to have 100 shares worth for each options contract. So the price was about $495, and that gave me a strike price of $110 per share. So in other words, Tesla stock was trading for $424.07 per share. I then had the option to sell the stock in 2 years for $110 per share. So this is a pretty high risk trade because the stock has got to fall 75% over the period of 2 years. But there's a couple of ways that options can go up in value. It doesn't just have to be the stock going under your strike price. The value of the option will go up if the volatility of the stock or the market increases. This is the VIX. That measures the volatility of the market and the volatility that's being priced into options. So nothing can change about a stock's price, but if the volatility of the market goes up, then the option's value is going to go up. The value would also go up if the stock fell. That is what happened over the following 2.5 months. And so those two things together work together to help make this a very profitable position. So let's get to the investment thesis. I talked here about how Tesla's structure, I think, is really a fundamental flaw right now for the company because it's built entirely on Elon Musk being the decision maker. Elon Musk makes all the calls about what sort of products are being made. He's involved in the design. This is not a company with divisions. There's not a Model 3 division or a Model S division. So when Elon Musk says, you know what, we're going to focus on robots now, we're not going to focus on cars, that means that the car business starts to get stagnant because all of the engineering, all of the marketing, all of the functional business models move to the new product that he's investing in. So that's their focus right now is 2 products, FSD and robotaxis, and the Optimus robot. That's where their investment is going. That's why you're seeing their product lineup get more and more stagnant. Yes, they've done some minor refreshes with the Model 3 and Model Y, but those models have not fundamentally changed much since they were launched. And if you look at the original Model S, it looks very similar to all of the vehicles, except for the Cybertruck in the Tesla lineup today. So it's a pretty stagnant lineup if you look at it compared to a traditional automaker. So that was a significant risk. It's just that Elon Musk himself is maybe not making the optimal decisions for Tesla. And now is Elon Musk's focus elsewhere. He's going to be working in the government for the Trump administration. Again, that was just beginning when this position was put on, but we've seen that that's had some pretty negative downside. And on top of that, the valuation was pretty crazy. So this is a chart from FinChat that shows in blue the company's free cash flow. And you can see that free cash flow has been falling over the past 2 years, $3.6 billion in cash flow. This was just as of the September 2024 quarter, and this was trailing 12 months. So we didn't have the Q4 numbers quite yet. And yet the stock price was rising. So the fundamentals are getting worse. You can also look at things like their margins. Their gross margins are falling. Their operating margins are falling. The price per vehicle is dropping. The margin per vehicle is dropping. Nothing about Tesla's operations is really moving in the right direction, except for energy, which I'll get to in just a second. And yet Tesla stock traded for 13.8 times sales, when a traditional automaker is going to trade for about 0.2 or 0.3 times sales. Tesla is, at the end of the day, an automaker. Until it proves otherwise, that's what the company is. So that should at least be a proxy for how we're valuing the company now. Tesla does not trade normally, so this is a huge risk. But this is the potential downside, is you have more than a 90% downside, I think, if Tesla stock gets back to kind of more industry average multiples. So I want to play against the narratives of the market with the reality of what was actually going on. First reality that I was leaning into is that Tesla is shrinking and losing market share. So this is pretty evident. And we have seen this with more and more data that has come out. We had the Q4 delivery numbers when this was published, but we did not have the Q1 delivery numbers. Those were absolutely terrible as market share declined, particularly in the US and in Europe. But look at these delivery numbers. This is a company that was supposed to be a growth company. These are all trailing 12-month numbers. Again, this chart is from FinChat. So you can see that total deliveries went from about 1 million in 2021 up to 1.8 million. But that has been stagnant for over a year now. And right now, after Q1, these numbers are declining. Margins also on the decline. So nothing is going particularly well right now. And Tesla's rankings, when you rank automakers and you're not just looking at one company, and I think this is where investors make a lot of mistakes, is if they're interested in Tesla, they're only looking at Tesla. Why aren't you analyzing it against General Motors and Ford and Stellantis and the vehicles that they're making? Because they're making very compelling vehicles and they're taking market share in electric vehicles. And this was data from Troy Teslake, who's somebody that pulls a lot of data up and publishes it on Twitter. In 2024, Tesla sold 657,000 vehicles in China, up 8% from the year. But what happened in Europe? Down 11%. US, down 5%. So your two main markets, the US and Europe, are in decline. In the market where you have the most competition from domestic automakers, China is the only place that you're growing. That's a terrible position for Tesla to be in, especially if you have the company's CEO getting into politics and you're starting a trade war with China. So again, in January, I was saying in 2024, sales were down in the US, Canada, and Europe, and China was the biggest growth market. That is a tough position for them to be in because tariffs on Chinese imports are going to make it harder to make money on these vehicles. Not to mention the Chinese market is extremely competitive. So again, we haven't seen the full impact of things like tariffs, but this was a risk that we knew about in January. Here's another narrative. FSD is miles ahead of the competition. Is it really? It's absolutely not when you actually look at the data. Tesla is a level 2 system with no visibility to full level 5 autonomy. That's just the reality. Here I pulled the 2023 numbers from California for fully autonomous vehicles. They don't have the 24 numbers out yet, but Nuro, a company that you may have never heard of, put 104,011 miles in full autonomy with 47 disengagements. Waymo, 3.7 million miles just in the state of California, 212 disengagements, 17,311 miles per disengagement. Tesla drove 0 miles with or without a safety driver. They have a permit to drive autonomous vehicles with a safety driver, but then they need to record a bunch of data about how many disengagements they have, what those disengagements are. They didn't drive any miles in the state of California in 2023. As far as I'm aware, they haven't driven any fully autonomous miles on commercial roads in any state in the US in the past few years. That is, again, just the reality. They are also, and this is true today, not a known operator in Austin where they say they're going to be launching a robotaxi service. Now, data for FSD is a little bit hard to come by because Tesla doesn't actually disclose much data. The charts that they show where they're trying to show their safety data is pretty skewed data, and it doesn't have a lot of the information that you get from a lot of other autonomous driving companies. But we do have data from a Tesla tracker. This is crowdsourced data from FSD owners. And this is something that Elon Musk himself has actually tweeted out. But look at the city miles between disengagements, 40 highway miles between disengagements. This should be a very, very high number. Remember, Waymo is driving 17,000 miles between disengagements. And those are primarily city miles. They just started moving to the highway. Tesla is going 633 miles between disengagements on the highway. So you can see how it seems like a phenomenal product if you're driving on the highway. But if you're potentially running into something every 40 miles on the city, that's going to be a lot of accidents when a robotaxi service launches. So again, this was a 2-year option, and I was leaning into the idea that Tesla was going to disappoint investors with a lot of their FSD launches and the potential robotaxi launch, while a lot of other competitors are actually moving forward with those products. You have companies like Volkswagen and Waymo working together in Austin. They are a known operator in Austin driving fully autonomous vehicles. There's an ID Buzz that they built that is going to be a ride-sharing service. You have companies like Uber and Waymo moving into autonomy. They're not building their own vehicles, but they're working with suppliers because they want to have lots of suppliers of autonomous vehicles on their network. So there's a lot of companies moving forward in autonomy and building basically their own robotaxi fleets. I don't think Tesla is a leader. It'll take a while to prove that out. And another proof point is that NVIDIA and CEO Jensen Huang has shown a lot of information over the past couple of months about their autonomous driving systems. Now, they're not making the autonomous software per se, but they're making the chips and basically the system that automakers can build their own autonomous driving systems. So they have their own operating system is what they call it. And synthetic data is a big part of how they're helping automakers build autonomy. So ironically, you have Tesla and xAI is one of the biggest buyers of NVIDIA chips. And NVIDIA is building the tools that is helping make autonomy become a commodity. That is really what's going on here. And that's what I think is so noticeable. There are a lot of flaws with the company's robotaxi business and the robotaxi business model. I just don't think they're going to be able to build out that supply and actually build out a network and make that a real business before tons of other competitors come to the market. We're already seeing a lot of those competitors on the market. So Waymo, for example, is really the early mover, but we're going to see more and more over the next few years. I don't think Tesla is going to be a big player in autonomy. The other story is that other automakers are going to license FSD. This is one of the craziest things that I think the market believes right now, because every single automaker, and I went through the 15 biggest automakers and what their autonomous driving strategy is, and none of them include Tesla. So you can just see all this here, but it's pretty clear that none of these companies is going to license FSD from Tesla. Then you move to China and all those companies are building their own systems in-house. Then think about the comments that Elon Musk made on a recent conference call. I think it was the fourth quarter conference call where he said, hey, we're not going to have conversations with other automakers. They're going to eventually license this product from us, but you're not going to have conversations with them because that's a waste of our time. What they should do is just buy a Tesla vehicle and look at where we put the camera, and then they can design around that. That's not how you work with other companies. That's not how you become a horizontal supplier, a company that's going to sell millions and millions of versions of FSD to other automakers. You have to work with those customers. Tesla is fundamentally not built to do that. Waymo is built to do that. So if you want exposure to FSD, a better play is Waymo, another stock that's in the Asymmetric portfolio. Let's also talk a little bit about robots. Is robots going to be the future for Tesla? Maybe, but there's a lot of companies that are playing in the robot business. Figure is a company that is advancing extremely quickly. Unitree, this is a Chinese company, but they're doing just amazing things. They put some phenomenal videos out on YouTube and Twitter if you want to look those up. Mirror Me, physical intelligence. There is just phenomenal things going on in robotics. Add Alphabet to that. I did a video on that recently. Tesla may be a player in humanoid robots in the future, but I'm not convinced that there's really a big business there. And I don't think it's going to be a multi-trillion-dollar business the way that Elon Musk does. So another way that there's potential downside for the stock. Energy is booming. This is a great story for Tesla. Look at this growth in the energy business. Look at this expansion of margins. What does this expansion of margins in particular come from? The Inflation Reduction Act. I put a couple of quotes here, just trying to put some numbers behind the impact of the Inflation Reduction Act. Domestically produced battery cells, $35 per kilowatt hour, $10 per kilowatt hour for battery modules. We don't know the exact subsidy that Tesla is getting because they don't disclose those numbers. Here's one of the things that I think they really should be disclosing is exactly how much subsidy are they getting from the US government for things like the IRA. But the estimates are it's about $2 billion. Go back up here to this chart, $2 billion, $2.2 billion worth of gross profit. So again, if this number is correct and you have about $2 billion in credits, that means that your gross profit, excluding subsidies, is zero. At the same time, what is happening with supply? This light blue column here is Tesla. Tesla had the most capacity in the US to make batteries and build modules when the IRA was passed. But guess what? More suppliers are coming. This is the estimates for how many suppliers are coming to the US. What's that going to do? You're still going to get that subsidy, but it's going to drive prices down. So eventually, that margin ultimately goes away. And that's what I think Tesla is ultimately going to be facing over the next few years, especially now if we see tariffs on battery imports from China, which is where Tesla gets most of its batteries for the energy business. It puts them together in the US, but it's getting the cells from China. If those tariffs do hit the company, this margin is going to go away extremely quickly. The other narrative that I love is that Elon Musk being close to President Trump was going to be a phenomenal advantage for the company. This was something that was really widely believed back in January. The reality has been, I don't think that he really does, at least in a way that is going to directly benefit Tesla, and it's offset by the negative impact from customers who don't want to buy a car from somebody who's involved with President Trump. Again, maybe a bigger impact in Europe than it is in the US, but you have Europe, you have the US impact, and then also China. Think about China. I wouldn't be surprised to see their demand in China drop just because of Musk's involvement with President Trump. So this was seen as a positive in January, but I thought that there was a lot of risk that has really turned out to be the case. All of this said, I could have been wrong. And the reason that I started this trade as a put option is because if I was wrong, the most that I could lose was $500. But the upside was significantly more than that. Now, put options do not have unlimited upside the way that a stock does, but over about 2.5 months, some of these things played out as I would have hoped. The market dropped, so this acted as a hedge. Tesla's deliveries declined, and as news came out of that, Tesla's stock dropped. Elon Musk's involvement with the government and President Trump ended up being a negative for the company's demand. Now, we haven't seen those financials yet, but we do know that deliveries were down. We had analysts reducing revenue and delivery and guidance numbers for 2025 and all of their estimates for 2025. So a lot of these things played out as I would have hoped. The portfolio overall fell, but this acted as a phenomenal hedge, and the stock really dropped late in the week of April 2nd after those tariffs were announced. The market dropped overall. And the reason that I closed this out on April 7th was because typically what happens with these kinds of things is deals are negotiated over the weekend. So tariffs were announced on Wednesday. I thought, the biggest risk that I have is that there's going to be some sort of deal announced on Sunday, and then the market's going to rip on Monday. That didn't happen. In fact, I think the stock fell a little bit on Monday, and I said, you know what? It is time to close this out because once there starts to be some positive news about tariffs, then Tesla stock could potentially move sharply higher. Like I said, this was disclosed to Asymmetric Investing Premium subscribers, took a 260% gain in a little over 2 months because of multiple things worked into my advantage. The market has fallen, the VIX is up, Q1 deliveries were awful, and tariffs were higher than expected. But I didn't want to take the risk that the time value of the option was going to work against me, and the worst news was likely behind us. We also have things like FSD and robots that could potentially provide risk, even if they're not actually deployed in large numbers. We have seen that Tesla stock can move dramatically just based on hype, not on fundamentals, but just based on hype. So that could potentially turn from a headwind over the first couple of months this year to potentially a tailwind later this year. It wasn't a risk that I was wanting to take. So I closed out the position and took a huge gain in this one special situation. So hopefully that's helpful in looking at why I took this position in Tesla in the first place, what the risks were when I took it in January, and why I took a 260% profit early in April Now, in hindsight, that has looked like pretty good timing, but it wasn't clear at the time that that was going to be the best timing. So we'll see how Tesla stocks goes from here. I still think there's a lot of potential downside, but with the nature of options and the position that I had on, I wasn't willing to take more risk. Now, if you want to know everything that I'm buying in the asymmetric portfolio and any special situations that I put on, subscribe to Asymmetric Investing. Like I said, there's a link on the screen and a link in the show notes. And if you like some of the charts that I use, check out finchat.io/ASYM. It is honestly the best tool that I have used in finance. It makes fundamental analysis so much easier than any other tools. You don't have to have 15 tabs open. All of the information for the stocks you're looking at are in one place. And on top of that, the screeners are phenomenal, and you can compare companies, you can compare margins, or you can compare multiples from different companies in an industry. So check that out if you want to take your analysis to the next level. Let me know if you have comments in the comment section below. Thanks for watching, everybody. See you here next time.